So, Ole, you cut your teeth over in London in the financial markets pretty quickly, and I guess sometime in the 90s you got on board with a hedge fund trading commodities. I've heard some pretty colorful stories from back then, but take us through a little bit what the environment was like at the time, early 90s, mid 90s, commodity trading, the pits especially.
Well, back then, as you say, John, it was open outcry. Open outcry system actually has been in place for more than 100 years, and it has proven its worth throughout centuries almost. But it was a very different way of trading compared to today, where everything is electronic. It was open outcry. It was in a pit. You were screaming and shouting. Every order had to be put into the pit through hand signals. So it just puts a limitation to how much you can get through and the kind of stress level that's involved. Also the kind of price you get out of the pit, the execution and so on. So it was an interesting time. It was a fascinating time. Some very hoarse voices at the end of the day. But obviously you felt the market probably a bit more than you do today, where it's all just numbers in front of you on the screen.
Yeah, I guess you really had a feeling back then as well. It being an open outcry market, all the participants, at least to a degree, those of course could be phoning in the orders, but you had maybe a sense of the positioning, a sense of the energy in a way that's just not available in the online days.
No, because today, and that's a good thing about modern trading, is that you have a price on the screen, a bid and ask, and that's a price that's available to everyone. Back then, in theory, that's how it worked as well. But at the same time, you also had to make sure when you trade into the pit that you shared your trade out among the participants. Some of those were so-called redcoats, locals trading for their own money, and obviously they were there to sniff out any signs of trouble. So sometimes you felt a little bit hard done by, because these guys, they could chase markets and find stop levels in the market. So it was a different ball game and a different way of trading.
Yeah, and you told me before, some of the locals, every house having its own colorful jacket, so you knew who it was you were dealing with. I won't ask you to take us through all the signals that some might have of the different participants. Deutsche and Goldman, I think, were some of the more colorful ones. But just for an example, what was the Bank of America? The hand signal if you were dealing with the Bank of America?
Yeah, exactly. Because obviously, once you got an order down from the customer, you signaled into the pit, and when you got the fill back, you had to tell the pit who was the counterpart. Yeah, okay. And obviously, you couldn't shout because there was enough shouting already. So all the different participants you signaled for the participants. And Bank of America was hand on heart.
Hand on heart, like Pledge of Allegiance,
yeah.
America. Okay.
Exactly. And as you said, some of the others are a little bit too colorful, which cannot be used in modern day. So incredibly, they got away with it back then. But you just had to know something, a signal that very quickly told you who you're dealing with.
It's sort of, there's been a democratization of the trading. In other words, spreads are much lower. They're much more visible. It's much more transparent. Commissions are much lower as well, because it's so frictionless to click a button in the IT systems around trading. During that process, what to you is the most remarkable thing about market behavior versus the pit trading days?
First of all, the visibility. That the price you see on the screen is also the price that's available that you can trade on, and you can see the size in the bid and the size in the offer. That's the price that's available to everyone, whether you're a retail client or whether you're Goldman Sachs with a massive order. So that's democratizing the market.
You have this easy access, but I think there's a learning curve that people need to be aware of from the investment angle. And that has to do with the forward curve of commodity prices and what that means, especially for somebody that thinks, well, I think oil is going up, or I think grains are going to go up in price. I will have some sort of passive exposure to that market over time. So take us through what people really need to realize and what the implications of that forward curve, first of all, what it is, and what it means for an investor as opposed to a trader.
It can be a little bit complicated, but it is, as you say, John, very, very important, because let's say you're in the oil market. You say your oil price is trading around $100. You think in 6 months' time it'll be lower. So you want to sell oil in anticipation of a price coming down in 6 months' time. The only problem is prices 6 months out is already trading lower because we have what we call backwardation. Basically mean that the spot price is trading at a higher level because we have tightness. Market are worried about supply right now or lack of supply, so that's why the spot price is trading higher than further out the curve. So even though you may be right in your assumption that prices are coming down, you have to really look at, well, how much is prices already trading lower out in the future. And that basically means that if you are investing into commodities and you have this kind of situation, then you're actually getting what we call a roll yield by being long, because every month the underlying provider of the investment to you will sell the expiring contract and buy the next one at a lower price. That gives you a roll yield. And that has been we've seen an opposite situation for a number of years up until recently, where the market was oversupplied. Now it's in tight supply, and that's also helping attract new investors into the commodity space. But I think generally it's very important. It's a volatile market, so always look, maybe to spread your investment, look for an index that covers a broad sector, or preferably the whole commodity sector, so you don't get caught out on a sudden move in the metals where it was actually the energy that was moving, or vice versa.
Online brokers like Saxo were key in helping to bring this process, this sort of access to the market from the pits, and as it got more and more digital and online, to traders, from the small speculator up to a larger corporate entity looking to hedge some of their exposure. You know, back in the old days, it really was just futures that you could trade. But as you talked about a little bit, there's other ways to get exposure to the market. You can also trade underlying companies that are active in the industry. But what other instruments are available to people that would like to get exposure in varying sizes to the commodities markets?
What has really happened in the last 10, 15 years that has made a massive difference is the emergence of ETFs. Because ETFs is just like buying a stock. Most people, they are familiar with buying and selling stocks. ETFs are exactly operates in the same way. And the main thing just to be aware of is that ETFs, where there's like a leveraged ETF, 2x or 3x, I tend not to use those, only really if you have a very short-term horizon. Otherwise, stick to the one-for-one, because they will, if gold goes up 10%, then the ETF will go up 10%, more or less. And by doing that, you really you can sleep at night. You don't trade the futures where you can suddenly get called up and say, we have X amount of 1,000 tons of sugar for delivery because you forgot to roll your contract. You don't have to worry about that in ETFs. But just know the market. Is it a market with tight supply, oversupply? If it's a market with tight supply, then you tend to get a roll yield by being long the ETFs. So futures, CFDs, ETFs, mining companies, so and even the spot contracts as well, spot gold, spot silver, so there's plenty of opportunities.
The key emphasis, though, has to be on that forward curve, especially in the case when people, I think there are a lot of people looking at maybe at commodities when they're especially cheap and thinking, wow, this is historically cheap. Let's say coffee, historically cheap prices. If there's a coffee ETF, maybe I should go passively long that for 6 months. But again, to be aware of how much it needs to go up relative to the forward curve to make sure that you're actually making money on a passive exposure to that particular product.
Yeah, because if you buy a stock, you can buy a stock that you find is cheap because you think over the next 2 to 3 years they'll do well and it's a good opportunity to get in. Commodities, they're settling on a daily basis, supply and demand. If there's too much supply, prices go down. If there's too much demand, prices go up. And that basically means that the price today reflects the current situation. And there can be some challenges in trying to preempt what it will be out in the future. So just make sure you know your curve and spread your risk, know your risk appetite, and don't put all your eggs in one basket.